everyone. Welcome to our AFIN3053 investment pitch. Today we present two high conviction recommendations focusing on events the market does not expect. The headline, 2025 investment calls, Mirvac buy and Apple sell, market versus model. The table shows current market price, our model-derived intrinsic values, and the key assumptions for both Mirvac and Apple. For Mirvac, the current price is $2.39 AUD, but our DCF and FCFF models value it at over $20 per share, using a WACC of 6.32% and growth rates around 8%. For Apple, current price $252.92 USD, but our models show a fair value closer to $200 with a WACC of 9.39% and negative growth rates. Our thesis is clear. Buy Mirvac because we expect a surprise upcycle in Australian property driven by rapid interest rate cuts, migration, and a surge in ESG capital inflows. VRAC is not yet priced by the market, and sell Apple. We anticipate a negative shock from global trade tensions, regulatory risk, and a disappointing iPhone cycle leading to a 20% downside. Here you can see inputs used for Apple and Mirvac's valuation. The risk-free rate is 4.11% for 10-year Australian government bonds, which is used for Mirvac stock, and 4.01% US risk-free rate for Apple stock. And you can see the relevant betas, equity risk premium, cost of equity, effective tax rates, and WACC. We have used key ratios such as operating working capital as a proportion of sales, PPE as a percentage of sales, and cash growth rates and equity growth rates to forecast the numbers and incorporating macroeconomic research findings. Now let's present Mirvac's macroeconomic analysis. The Australian property market has rebounded faster than expected in 2025, driven by earlier than forecast interest rate cuts and a stabilizing economy. Major banks and government forecasts predict sustained price growth through 2026 as rates track lower and migration surges. Australian population is projected to grow rapidly, especially in major cities, with 800,000 new residents aged 21 to 50 expected in Sydney and Melbourne over the next decade. This drives demand for both residential and commercial property. The commercial real estate market is forecast to grow at CAGR of 4.4% through 2034, with retail and prime office assets leading the way. Mirvac's diversified exposure positions it to benefit from sector-wide tailwinds. Our Excel calculation for free cash flow model derived an intrinsic share price of $21.12. Now, Kartar will explain further Mirvac's analysis and justification of Apple's forecast.
Thank you, Karan. Let's now discuss the key factors that we use in Mirvac's valuation and forecast. Mirvac manages a $29 billion development pipeline diversified across office, retail, industrial, and residential sectors. The group's 97.7% occupancy rate and A- credit rating from Fitch support financial flexibility and resilience. Mirvac's net profit margin exceeds 23%, with equity growing at 8% per annum and strong cash flow conversion. Our DCF and FCFF models show Mirvac's intrinsic value to be 7 to 8 times higher than market price, with sensitivity analysis tables confirming upside across conservative scenarios. Let's now discuss Apple's top-down analysis. In 2025, escalating US, China, and EU trade tensions have led to new tariffs on consumer electronics, directly impacting Apple's margins and global demand. Regulatory scrutiny of AI and data privacy is rising, with potential for costly compliance and operational restrictions. The global tech sector faces valuation headwinds as growth slows and investors rotate into value and defensive sectors. Apple's forward PE remains elevated, increasing downside risk if earnings disappoint. The iPhone 17 cycle has also underperformed, with consumer upgrade fatigue and competition from Asian OEMs. Analysts have pricing resilience, but weak execution and AI feature disappointments on the iPhone 17 have triggered negative earning revisions. Here below is an extract from Apple's free cash flow valuation model that derived an intrinsic share price of 196.53 USD. This reflects a downside of 22.3% when compared to the current market price of 252.92 USD. This comes as a negative shock due to various factors where we expect Apple's revenue to decrease. Apple's service revenue continues to grow, but hardware margins are compressed by higher costs and weaker demand. Net profit growth moderates, and cash reserves are increasingly needed to buffer operational risk. DCF and FCFF models show intrinsic value of 20% below the market price, as you can see in the sensitivity analysis table. The various share prices for various WACC and growth ranges. Apple's operating margin remains strong, but increased capex and research and development leave the company exposed to innovation cycles and regulatory cost spikes. Here we can see the references that we have done for this project. Thank you for your time.